intro music. All right, good morning, good morning. This is the Rags to Riches stream. Let me just give everybody the link in the chat and get everybody to be able to join here. This is an important one. So I want to make sure that everyone here has the opportunity to attend. Welcome to everyone who is here. Also, for those who don't have premium access, I did just add one more of my SPX contracts. Obviously high risk, so please don't copy me. But this is kind of how I trade SPX, high risk, high reward, which again is not necessary, and we're going to cover that today. So let me just give everyone else a couple minutes. I'm going to pull up this as well. Okay, there we go. Sorry, I just have a bunch of windows open here. I want to make sure that we can access everything. Okay. Very, very good. All right, just going to give everyone another minute or so. So 12:02-ish, we'll get rocking and rolling. And then AEHL, obviously, from this morning is also just halting back to back. It's like 9 or 10 halts at this point. It's insane. Just to recap, also AIIO, grabbed my entry here, sold on a pop there, and then sold on the pullback just because I didn't like what it was doing. And then, of course, it went higher, but that's okay. We don't take that personal. AEHL, I grabbed an initial piece in the first 5 minutes on a very small position. Ended up taking a small loss on that one, and then I grabbed a second piece, and then we get a much larger profit, and I sold my last shares, I think it's 65%. So that's all on the speculative side. Not at all to do with the Rags to Riches, but I do like to share for transparency here, just to show everyone kind of how I do things and what I'm doing, good and bad, right? So you can see that I do take losses. I do have drawdown. My abilities allow me to regrow those big losses. So if you don't have that, then you don't want to take the high risk stuff that I take. So that's the idea here. INOD, we had a little profit on that as well. Just a quick in and out, and then I scaled out, sold the rest above this line here, and then it just rejected out of that zone, so no trade on that. And then GDC is just dead in the water. It's kind of been like that all morning. We had that initial sell-off, and then it just kind of ranged sideways, so no entry opportunity on that one. So the only thing I have left is my SPX position. And for that, I'm looking for a bigger move, potential gap fill to the downside, which is going to be largely rooted. I'm just kind of saying this for the record here. In an NVIDIA sell-off, AMD has been kind of propping Qs up for the day. Once this starts to turn back down, this should turn back down, which is the Qs. It's the tech sector ETF, and then SPY should pull down, which should lead to our potential gap fill. At least that's the theory. So now we just have to see if that actually happens. So with all that said, oh, yep, I have to share my screen for you guys. Oh boy, sorry about that. All right, I won't recap them all, but you guys get the idea. We're looking for this one to sell down, which should drive the tech sector ETF down, which should drive SPY down, which should then lead to SPX moving down. That's the general idea. What's up, Duco? I left you cold and alone. Stranded. Well, I hope you're not alone. You had other people in there. You got Heaven, Cart, and Chris. What's up, Baron? How's it going? Welcome, welcome. So that's just kind of in the background. That's a speculative side. That's from the live stream this morning. Just again, sharing for transparency and making sure that everyone has a full view of everything. Unforgivable? Oh no. I'll earn it back. Don't you worry. I'll make it right to you somehow. I'll find a way. All right. So this is the Rags to Riches stream. So I want to first off just preface this by saying I have an hour. I don't have a lot of time. I do try to keep these constrained to an hour, but I also do ramble a lot. So you guys are going to get at the fire hose today. So the big important announcement right now is the new structure of Rags to Riches. And that is basically that I think a week or two ago, I said I was going to take 5 members and kind of bring them into this program so that they would all have the ability to be monitored and to be mentored publicly so that people can kind of see the process. But with only 5 participants, that allows me specifically to focus more on their progress individually in front of everyone, as opposed to having 55 people, and then I can't physically cover everything that's in their portfolios on an hour stream. So I wanted to reduce the number because the last cycle, it resulted in like other people kind of adding people into the program. And sometimes I didn't even get to talk to those people. So it just kind of got a little bit unwieldy, and then they didn't have access to the spreadsheet and so on and so forth. So this time around, I'm taking 2 old lifetime or 2 older Rags to Riches members and then 3 new Rags to Riches members, and that will result in a cumulative 5. So I have some good news in that I'm actually expanding that. I'm going to make it 10 people this cycle. So 10 people who applied are going to be joining the team. I'll make a legacy role, and then I'll transfer all the Rags to Riches members that are currently on over to that later today. And then I'll do all the role swapping and stuff later. I just didn't want to do it this morning. And then I will give the new 5 members their 10 is the number we started with, Duco. It's exactly what we did last time. That's strike 2 for today. Oh no. All right, so I'm going to announce who they are right now, and that is Elizabeth. I don't know if everyone's here. I'll also be tagging all these members in the channel. It's going to be Elizabeth and Junjun. We got our power couple there. Epic, you're in. Druv, you're in. I see you guys are here. Thanks for hanging out. Onrod, you're here as well. Absolutely. You and Snowflake definitely always have room on this. Vinny, I don't see you in here, but you're in here. Iceman, I don't see you in here either. Carl with a K, I don't see him on this stream either. And Charlie, obviously, you are an easy shoe-in because I think you and I are very closely aligned. So the letter of recommendation came through. I think that letter worked against you, but it was all the other stuff that kind of... Duco, you didn't apply. That's why. That's why there was an application, buddy. And that's just to make sure that I had answers to certain questions beforehand, to make sure that we could do this the right way. So if you want to, I wouldn't object to adding you in, but there was a process, and I just want to make sure that I have information up front so I can make these decisions. So for those who didn't get selected, it's nothing personal. It's just I was just looking for very specific things, and I just want to make sure that the people who were selected had a good mix of what I was looking for, because I don't just want to pick 10 of the same people or the same circumstances. I want a variety here, because that's kind of the value in having a team like that. So it's to demonstrate that everyone has the potential to do this. It's not just something that someone who has a large account or someone who has a bachelor's degree or someone who is able to focus on the charts can participate in. You don't want to be in, you just help from the sidelines when needed. Just wondering why you are a Duco racist. I mean, I feel like that'd be called a Dukist. I don't know. That's just who I am, I guess. I've had some experiences with Duco-like people in the past. I'm just kidding. So I'm going to give you guys a very brief rundown of the engine that we're going to be building and kind of why it's important. And along the way, I'm just going to ask you guys for some feedback to make sure that it makes sense, because I see a lot of people that have been on these streams in the chat, but I also see a couple new people. So I want to make sure that the way that I'm presenting this information makes sense, because we're going to start digging into the individual pieces on subsequent weeks. Okay, so today you get the high level view, and then I'm going to kind of walk through the process. And if you're on the team, when I get you guys those roles, I don't want you guys taking action today. I don't want you to just start making a bunch of random changes. I want you guys to just take in what I'm saying, scrutinize it, make sure things make sense. If they don't, we have the chat, we can talk there. But more importantly, just make sure that you start prepping your mind for these kinds of things, right? Because it's going to be very important for your long-term goals. So I'm going to show you how I do stuff, and then I want to help you guys all understand the various pieces, and then to pick and choose your own specifics to plug into each of those slots. Like, for example, with the day trades, we don't have to do flat position sizes. We don't have to use a 10% position or whatever when we're speculating, just like we don't have to do 7 dividend stocks, right? I'm just doing that for demonstration purposes. With the position sizing on the speculative side, we can use 1% rule. And over here, we can use maybe another 70-30 split within dividends, so that we do 70% growth ETFs, 30% income ETFs, or whatever we want to do. So the individual contents of each box is up to you. And I'm going to teach you guys how to build the engine. But the blueprint ideally stays roughly the same. The structure is built this way for a reason. So first, I want to see if things make sense for you guys. Then I'll walk you through individual pieces, and then we can flesh those out in real time and show how it works in practice. Okay? So the first thing that we like to do is make sure that we absolutely nail financial security outside the market. Again, this is a passive income focused strategy. It's not a 0-day SPX trade everything you can as fast as you can strategy. It's designed to be passive so that you don't have to rely on the market and speculating to make your money. So if you are not financially secure outside the market, that will introduce a lot of pressure to make things happen in the market. And that usually means that you're going to end up taking risks that you don't have to take, right? So part of financial security outside the market is establishing things like a budget, making sure you're building and maintaining a healthy credit score. Even if you don't feel like you're going to borrow, having a good credit score will save you money. And then all the dollars you can save without relying on ramen and being unhealthy go over into the next step, which is consistent contributions. Okay, this is important because if you're able to make consistent contributions, you are treating it like a savings account, and that is one stream of revenue that's pouring into this portfolio over time. Okay? And that is the goal. You want this value to grow as efficiently, but not necessarily as quickly as possible. Okay? It's all about efficiency. So if you're just putting money in, maybe you get broker settled interest. Maybe you don't, and that's okay. Either way, you're not losing money, right? You're not throwing money into high risk stuff just for the sake of trying to make it happen. You're already giving yourself an advantage that 90% of other traders don't, because they just can't slow down, right? Then we want to take those contributions and we want to split them into some ratio between investments and speculation. I personally use a 70% investment speculation and a 30% speculative allocation, 70% investment allocation. So that means that if I put $1,000 in, $700 goes towards investment, $300 goes towards speculation, max, right? And sometimes it might be like an 80-20, sometimes it might be a 90-10, sometimes it might be 100%, 0%. If you don't like speculating or you're not able to demonstrate consistent net profitability, there's no reason to force it. You can always just put your money into the investment side if you prefer that. And for the investment side, it doesn't even have to be market investment, right? We can put these into high yield savings accounts. We can put them into a 401k if you have one. We can put them into bonds or something more stable until you're able to get your feet under you and understand what you're doing and prove that you can make a result, right? And then within the investments, if you're choosing to use the market for that, then we typically allocate a number of positions with given ratios. So for example, if I like Johnson & Johnson for a long-term investment, then I will buy a larger amount of Johnson & Johnson because it is a growth investment. It's something that I want to appreciate over time, and I want to hold it for a long time. Okay, that, if it offers a dividend, means that I will be charged taxes on whatever I collect in the form of cash, right? Whether it's selling shares or whether it is collecting dividend payments on a recurring basis. So I need some way to offset the taxes, which is where we get into the yield max ETFs or other forms of tax loss harvesting towards the end of the year so that I can reduce my taxable income after I've reinvested those dividends, because I want to have a good mix of growth and income positions in the investment side. Growth means we're just buying and holding. We're not selling. We're just hanging on to them until pretty much till we die, right? Income stuff is things that we're looking for more aggressive dividend income, or we're trying to sell the shares within maybe a 2-year time frame. We're using it for a very cash-oriented outcome, right? And I'll walk through all this stuff over the next 8 weeks, right? We got plenty of time, but this is the process. We want to get a bunch of income and then invest that income almost immediately, and then also sell stuff for losses in smaller amounts so that we can offset the cash that we got and reinvest it. So we keep the share version of that money, but we don't have to pay money to the government for having had the money. Does that make sense? It's I know I worded that horribly, but the idea here is we're taking this is an engine, right? We're taking money, we're turning it into another form of value, and then that is providing another form of value to us on top of that. And then we're taking that value and turning it into even more of the share form or ETF form for future payouts. But then since we got paid, we have to offset the taxes. Okay, so it's a little bit of a complex system there, but I'll walk through all of that and how it works in the future. But that's the main piece that drives this whole engine is that reinvestment process. Okay, so as we get dividends or other forms of income, we reinvest them. They go right back into the portfolio, and this is the second form of revenue that comes in and helps this number grow. Okay, so far, if we take out all the speculative stuff down here, if we put 100% of our money into the portfolio as far as how much we allocate out of our budget for contributions, and then we take 70% of that and put it into investments, and we've got a good ratio of income versus growth positions, and we're reinvesting the payouts from those into more and more equity, more and more of these shares or ETFs, and then we're selling little pieces for losses to offset that little piece of it, we should break even in terms of tax burden, and we should increase our net value over time. And that's the goal. You want to amass a large amount of asset value because the end goal is not just making money. It is finding ways to make money without paying the government more than you have to. So when you get up to a certain level, there's many ways to accomplish the same end result, but I personally prefer to take out what's called a S block. It's a securities-backed line of credit. And the trade-off there is instead of paying the government 30 to 35% in capital gains tax every year on dividends and things like that, I can just take out this S block, still keep all my assets, and then I just have a revolving line of credit where I pay maybe a 3% rate, right? So I'd rather pay 3% than 35% because I'm not getting more representation and more government services just because I pay more, right? And so I'll leave the ethics of that kind of in everyone's plate, but my goal is to take care of myself and my family and my immediate community if I want to, and then contribute to whatever causes I believe in. It's not to fund an inefficient government if I'm not going to be able to use that to benefit myself and others. So with that said, that's stream 1 and stream 2 of revenue. Then we can talk about the speculative side. And the speculative side is pretty straightforward, and this is optional. You don't have to speculate if you don't want to. I will be teaching you guys some basic and simple things to do so that you can survive and grow small amounts of money, not in spectacular ways. We're not going to be doing high risk stuff. We're just going to be doing very consistent compounding profits, and we're gonna do it in a very mechanical way. Okay, so we're going to allocate some number of trades per day, and we're going to have some win-loss conditions filtering out how many we take on any given day. And then we're going to talk about position sizing strategies. So either we're going to use the 1% rule based on risk range so that we get exact outcomes every single trade, or we're going to use flat positions, and then those are going to give us variable but still disproportionately profitable profits when we win. Then that will give us a finite number of outcomes, okay? And this is what we're after. We're after predetermined outcomes. So if I take, let's say, 5 trades per day, I have a 1-to-2 ratio, meaning that in this case, if I only risk $20 per trade, I will have a 1% loss, which is 20 cents, or a 2% profit, which is 40 cents on every single one of those trades, which gives me 6 outcomes, right? I have 5 listed here, but that's only because those are the non-zero outcomes. The alternate outcome there is you just take a day off and don't trade, which means you don't lose anything. But the idea here is that just with this specific configuration, we get 5 potential outcomes which adjust our numbers. So we're either going to gain $2, lose $1, or anywhere in between, plus or minus some slippage, obviously. And 2/3 of these are profitable, which means they increase our amount. And I only have $20 here as an example. The number is going to be proportional to your 30% that you contribute. Then we take the profits, the 2 out of 3 outcomes here, and those goes towards reinvestment into the investment side. And I'll walk you guys through how I do that as well. And then the other 1/3, if we let's say we get 1 of each, right? The other 2 potential outcomes here go towards tax advantages for tax loss harvesting, because we can deduct our losses against our profits at tax time, and that reduces our taxable income, which helps us get that number lower and lower and lower so that we get a bigger, fatter refund, and then we can recontribute that back in, which gives us our 4th form of income into this portfolio. So it's all about leveraging the amount that goes in here and making sure that 3 out of 4 of those come from within the market itself and not just the contributions. Does that make sense so far? If it does, please just put a 1 through 10 rating in the chat just so I know if I explain that well or if I need to slow down, because I ramble a lot and I say a lot. But I want to make sure this engine makes sense and that everyone understands kind of the reason why each of these components exists. Max amount of sense make. Thank you. That's my goal. So again, we're gonna have 8 weeks here. We're gonna go through every single piece of this, and we're gonna walk through it until it makes sense to a much deeper degree. And we're gonna have some people here that also aren't in the U.S., like Baron here. He's not in the U.S., so his rules might change a little bit. He might have to pay commissions, which might affect this number here, or it might decrease this number here. He might not be able to use his taxes the same way. I believe he said his taxes are calculated automatically, and I think they're 50% right off the bat. Correct me if that's inaccurate, but I think that's what you said. Somebody in Canada might have different rules to follow as well. They don't have as good, like their dividend income is treated differently, I think, when it comes to taxes. So their capital losses are handled slightly differently. So you're going to have to, unfortunately, some people are just going to have to do their own research, or I'll help them. But some of these things are going to be different, which is why I'm not giving you guys just copy me approach, because you're not all going to have the same circumstances. So that's why I want you guys to all understand the pieces, right? Individual pieces, and then you can plug yours in. For Baron, for example, if he has to pay commissions, the 1% rule is going to have to incorporate those commissions. And he's not going to want to take a bunch of trades because frequency will lead to diminishing returns. So for him, it's going to be slightly different than someone, say, who's in California, for example. Trading and tax are done automatically too if it's a bank with office in Belgium. Absolutely. So there's always going to be little gotchas and exceptions to the rules, which is why I'm just showing you guys the overall framework. And then you guys plug in the specific pieces based on what works best for you. You get what you mean in concept, but I'm very curious on how we execute. So that is going to be part of the whole process. So I'm going to build a spreadsheet, and that spreadsheet will have 10 tabs on it. Each of you guys will get your own tabs, just like we did the first time. And on those tabs, we're going to have like total account value. We're going to have open positions. We're going to have just the investments listed out. Okay. I don't really care about your speculation. No offense. But that is just a gas pedal at the end of the day. I'll teach you guys that stuff. But at the end of the day, if you're putting in some number of dollars and you automatically lock up 70% in high quality long-term investments that are providing consistent output, and then you put the other 30% into speculation and you completely blow up the speculation. Let's just say you just go balls to the wall, lose it all in one day. Your account should still grow over time because you're losing less than you're putting in. Does that make sense? And at the end of the day, all those losses go towards taxes in most cases. So you're not really hurting yourself. You just don't get that money to play with right now. So if you can control that and you can use the actual losses for taxes, it's not necessarily a bad thing. But you're not going to get glorious results because you're setting yourself back by losing on the speculative side. So in that case, I would encourage everyone who maybe can't yet prove to themselves with data that they're able to achieve a net profitable end result on a consistent basis, maybe don't put 30% in speculation if you're not comfortable with that kind of speed limit. If you want to do 90% investment, 10% speculation while you're learning, I fully support that. I can't tell you to do that, but I fully support that because it means that you're prioritizing preservation of capital and you're still learning on a smaller amount, which doesn't require huge amounts to use. You don't need to really risk any dollars to learn the shapes and colors at the end of the day. So we're going to go through all this step by step, but the way that it would look in practice is, let's say that you've got your budget figured out. I'm personally going to be adding in, I'm going to use probably a sim account for this just because I don't want to have too many real accounts floating around on these streams because I don't want to confuse people. But we're going to have assume that we had a budget mapped out and we had a number in mind where we could make a consistent contribution, let's say $200 a month or $100 or $10. That's going to vary from person to person, and that's okay. That goes into a portfolio, and that just kind of dictates where some ratio that goes. So let's say we did let's say we put in $500 a month, right? Then that would go in the portfolio. $350 that would go into investments, and then maybe I add $50 each to 7 positions that provide dividends and tax advantages, and then 30%, so $150, would go into speculation, and I could just trade with that $150 to achieve either a, let's say what would that be? It'd be like a $1.50 loss or $3 profit per day, and you got $150 to do that with. Not that bad, right? Because you're not risking a lot, you're not losing a lot, but those $3 a day compound, and that 150 adds up very nicely. $3, sorry, adds up very nicely as it compounds because it's percentage oriented. And that would just give us our result of either reinvested cash as we trim the profits back, or a tax advantage if we take those losses. And then the next month rolls around and we contribute another $500, right? So even if we lost all $150 here, we'd be sitting at $350 in the portfolio. We add another $500, that's $650. We take 70% of what we just added, so another $350 goes into the investments. We have another $150 on deck for speculation. Let's say we blow that up too, right? So now we're at $650. We got a bunch of dividend stuff rolling. We put another $500 in. That's $1150. So $150 that goes to speculation. $350 goes into investments. Let's say we blow up speculation third time in a row. We lose all $150, right? Like, that's the whole process. Is we're just losing less than we put in, and we're amassing longer-term passive profit positions that will reinvest those profits on over and over and over again. And that starts a miraculous little ball rolling where we don't have to think. And then anything that we make on top of that just gets reinvested and speeds up that piece of it. Does that make sense? So that takes so much pressure off the speculation, because we always put way too much weight on ourselves to try to make this stuff work, and that hurts us. So, if you're struggling on the speculative side, or if you just don't care as much about it, you don't have to do it. That's the cool part. But I believe that everyone here should have a big, much larger pool of passive income resources, because eventually, like I say all the time, even if you're a master trader and you can just nail every single trade and just grow portfolios very, very quickly, you're still going to run into things like liquidity ceilings, and you're still going to have limits to what you can participate in the market, which is where this comes in. You need this ball to roll, and eventually the dividend income will outperform the amount you're able to make on speculative trades. And that's the tipping point where this process just goes parabolic. And then beyond that point, right? Because this is asset building. Then you go to the specialized lender like Morgan Stanley, and you take this big portfolio of assets, and then you say, hey, I'm wealthy now, give me money. And they're like, all right, cool, here you go, wealthy person. Give us 3% back every year. Let's see what you do with it. And then you just go live on that, and then you can very easily pay off that 3%. And it's a line of credit, so you can manage that very effectively. And all the building blocks are still in place, and you still keep all your assets, and you still keep those dividend payouts coming in over and over and over again. And you can still offset that capital with tax loss harvesting at the end of the year. And then it's a beautiful process. So that's the goal, but we got to take baby steps to get there. So step number 1 next week is going to be budgeting and building and maintaining credit. So show of hands, who here in the chat believes they don't need a credit score right now? If you don't believe you need a credit score, go ahead and put a 1 in the chat, and that's all I'm curious about. There's no wrong answer. I want to emphasize that even if you're successful and you have money and you don't ever borrow, having a good credit score is still advantageous. 420. And the primary reason for that is because, again, there is a tax that comes with not having a good credit score. If you don't have a good credit score and you have, let's say, $15 million, and you go to a bank and you say, hey, I want to take out an SB lock, they're like, all right, cool, 19% APR. As opposed to maybe someone who's got an 820 score that gets a 3% APR. Well, so I'm not saying it's a wrong answer, but I am saying that you will definitely pay more if you don't. So you can still do those things, but you're going to pay a lot more than you have to. So I didn't have a credit score. I went into, and it's not just that, it's the opportunities that credit scores provide as well. Like when I was in the Army, I couldn't get a clearance score, the clearance, because I didn't have a credit score. And part of that is a background check and a credit check. So I just always had money, so I never built credit. And then there I was trying to be, recon guy and couldn't get a clearance score. So I had to wait and go through extra hoops and all that other stuff that I otherwise wouldn't have had to. Yeah, and that's it. You don't need a good credit score, but it helps, and it definitely gets you cheaper access to things because, yes, 19% is cheaper than 35%, but 3% is a hell of a lot cheaper than 19%, and it's also a hell of a lot cheaper than 35%. So you just pick the lesser of two evils there and just build it. You don't need money to build credit. That's another misconception. We'll get into all that on the next class. But first is going to be budgeting. We're going to talk about how to reduce recurring expenses, things like that. And then we're going to talk about credit building, because every dollar you save, again, without impacting your lifestyle, is an extra dollar that can go towards contributions, which is an extra dollar which speeds up this whole process early on. And the earlier you build this process, the better that trajectory becomes long term. It's like a penny a day, but it doubles for a month. I'd rather start that on day 1 of the month than day 15 of the month, so. Dugo says, I know how to budget, but how do I control my wife's spending? That is part of the budget. We're going to talk about all that stuff. And no, the answer isn't divorce. Well, I mean, it might be for some people. Budgeting is a family thing, unfortunately. It's something that requires participation, and it requires communication, and just like having a trust or a will, right? You have to prepare your family for any significant changes that are coming up in your life ahead of time. You can't just, I have all this stuff in place and now you're ruining it with your spending, because that's just going to lead to resentment and stuff like that. So there's a diplomatic way to approach it, and then there's the surprise you're the problem approach, and that one doesn't end well. Shoot your wife's horse? What did the horse do? Are they having an affair? Is the horse out on eBay spending money? For legal reasons, you don't have to answer that. Oh, save a lot of money. Yeah. Where's the there's a stock image. Let me see if I can find it really quick. I always love this one. Let me see if I can pull it up here. It's I think the first time I ever saw this picture was some lady talking about how to cut household expenses or something. It was great. That always just stays in my head. So that's the plan for this course. It's not going to be shooting animals, but we're gonna talk about getting clear and clean visibility of all of our expenses, our inflow and outflow, understanding the difference between the two and the gap between them. We're going to talk about things that impact credit. We're going to talk about every way that we can possibly free up extra cash flow for these consistent contributions and other things like paying down debt and stuff like that, because all that snowballs, so that we can optimize the contributions to our portfolio as a last priority, right? Market always comes last. So it's kind of those hurry up and wait kind of things. Like, yes, prioritize it mentally, but don't sacrifice other areas of finance to make this happen, because this is a long-term thing, and there are risks, okay? So then we're going to talk about the investment stuff first and foremost. I'm going to walk you guys through exactly what I look for when I look for investments, in both the growth area as well as the income area, and kind of how those positions play against each other. Then we're going to talk about what to do with the dividend payouts and kind of how to reinvest them. And then also how to deal with tax loss harvesting at the end of the year, so that you can keep track of these profits and then offset them after you've reinvested them and turn them into share form, right? So, and at the end of the day, all you're doing is turning cash into other form of cash, and then that produces another chunk of cash, and then you're just taking other pieces of cash that you've lost and canceling out the cash that you were given. So I'll make it visual and it'll be fun. Then we'll build into the speculation stuff, and that'll be a very simple, very easy conversation. And you guys already know the 1%, 1.5% stuff works. It's just a matter of applying it on a consistent basis, if that's what you prefer to use. If you prefer a different thing, you can do a different thing. We have Bull stuff, we have Lee stuff. They both have very good coaching programs. I have my momentum stuff. We can also do swings, but the emphasis here will not be on speculation. It's going to be on long-term passive growth and the compounding reinvestment effect. Okay. And we're gonna really gear towards predefined outcomes, a finite array of predefined outcomes, so that your losses and profits are controlled, because you want to have a relationship between the dividends and the passive income and all of these, and you want to keep them in balance, because you're going to track those as the year goes on, and then we can offset them, right? So if one of these is out of whack, you're going to pay more or less in taxes, right? So the goal is to keep a nice flat balance, so you're not losing too much, but you're also not gaining too much too quickly, because that's going to maybe force you to have to sell some of these investments if you owe a bunch in taxes. And we don't want that, right? We don't want to sell any of these to cover any expenses, because we want to buy and hold these till we die, for the most part. Because again, we want to amass this value that we can take to a lender and then get around taxes by doing the wealthy guy thing and just getting something like an S block. Okay. So if that makes sense, I think that I have done okay enough for this stream. I want to go ahead and walk through again the process. So you 10 members that are on the team now, I'm gonna put all the older Rags to Riches members into a legacy role. I'm just gonna change the role that exists. I'm gonna add you guys into a new role, and that's gonna be Elizabeth, June, EPK. I assume it's Epic. I'm just gonna call you Epic anyway. Drev, Onrod, Snowflake, Vinny, Iceman, Carl with a K, and Charlie. You guys are all gonna be given a new role. And a spreadsheet. I'll give you guys access to the spreadsheet, and then we'll build our stuff out there one element at a time. And then we'll track it, and it'll be public and accountable. It is Epic. Okay, good stuff. And then we will make sure that you guys are publicly mentored and can grow your amounts, and then we'll see what the data shows at the end. One thing that I do encourage is, if you don't want to use real money for this, because I'm not going to be telling you to buy or sell anything, open up a sim account, open up a paper trading account, but you may have to track your dividends manually if you do that. So I'll teach you guys how to do all that. But yeah, we'll see how it goes. Trying to think if there's anything else that I really want to do. I might just turn the small cash account into that as well. What do you guys think? You guys think I should just turn this cash account into a Rags to Riches account again? No? Yes? No? Yes? Maybe? I'd rather just use one account for all my streams. I just don't want to have, 2 accounts floating around, or 5 accounts, Straight cash, homie. All right. And so I'm kind of against doing that, because I'd rather, I'd rather just keep it loose, because once that PDT rule change kicks in, I'm going to want to switch it to a margin account anyway. So I don't know. Duco says don't do it. Okay. So I got 2 no's from the same person and a yes from another person. I feel like we needed to have a trial. I'm sensing some probable cause here. Let your students show the way. I mean, that is the ultimate proof of concept here. So let me ask really quick: any of you members that are newly on the team, are you comfortable using a real account? Given that we're going to be sharing these positions, not your account numbers and stuff. I don't want that to ever be public, but you will be reflecting what's in your portfolio on the spreadsheet. Is anyone here not comfortable using a real account? Onrod's an open book. Okay. Duco, yes, you do. You judge. Shin says, so on your Rags to Riches account, do you trade every day? That's optional. You don't have to. That's the whole point, is you can take this 30% speculation out completely, set it flat, lose it all, blow it up. It doesn't matter. Your account will still grow, because you're still taking 70% of those consistent contributions and putting them into investments that compound and grow over time. So it's dealer's choice at that point. How fast or slow can you make that growth happen based on the data you've collected so far about your ability to grow a speculative amount? So I personally, yes, I trade every single day if I'm in front of you guys, but if I'm not, like, this money is not really significant. So no, I'm not going to spend time on a small account other than to share progress with you guys. Epic says, I'll be opening Webull so I can share everything. Okay. Drove says, I'll be using a small account. Perfect. Okay. Yeah, whatever you guys are comfortable with. If anyone is not using a real account, I would recommend using a site like the dividend tracker, and I can get you guys links for all that when we're ready. And that will allow you to kind of quote unquote buy those positions in that virtual portfolio, and then it'll track the dividend income separately for you. So it's a little bit easier to keep track of. But if you're in a real account, there's no point in adding extra software in the mix. You misspelled delete. Fair enough. All right, so first off, we got we're about 39 minutes in. Does anybody have any questions about this new cycle? Anyone who's on the team or what's up, Duco? What's up? Lay it out for us. Can we boot Nikki? Well, for what it's worth, Nikki's not on the team. Onrad, we're going to start now. Not right now. We're not going to be buying stuff right now. The cycle starts today, and I'm going to run it for about 2 months. We'll kind of wing it because it's the first cycle. I just kind of want to see how it feels and kind of see how long it might take to get you guys up and running. But last time we did it, it was about 2 months before people started really just kind of falling into it and seeing the results, because it takes time for dividends to come in. So while that's in process, we're going to be using that time for education. Oh, just out of the channel. She's not a free member. Well, I'm not opposed. We'll put it up to a vote, and then if they vote to keep her, she gets to do whatever she wants to you. Okay, that's a trial by combat. So, who's going to be merciful and who's not? Yeah, Nikki likes that. She likes that outcome. Yeah, don't spank him. What's mercy? It's a French word that means hit him some more. Thank you, I think. Yep. You don't need safe words. I mean, that you could get a little philosophical with that, and that nobody needs safe words. But we'll cover that later. So with all that said, anybody that has any questions about Rags to Riches, now is the best possible time to ask, because on future streams, I would like these members to get on mic and chat with us if they want to, or if they're able to. And it's going to be a lot less focused on the overall process and more about the individual components to this engine. So today you get the high level view. We get to announce who the team members are. I'll move all the roles around and get them all shiny and elevated in a little bit. But does anyone have any questions about the Rags to Riches process or engine before I jump off of here? Also, fun fact, I'm going to try to record these. So we'll see. Duco, I hope great success to all the members. I'll be cheering from the sidelines. I hope so, man. I would love for you to be in on this too. I know you're super busy, and we'll definitely keep working towards getting you on this team. Actually, those who aren't familiar with the history, Duco has 4 P's next to his name. That was an old, towards, I want to say the middle of the cycle, maybe the end of the last one before we kind of got a little out of hand there. We broke up a homework assignment into teams, small teams. And that was one of the teams. Each team had a specific task to accomplish as far as researching a company or an ETF. And then the other one, that was pretty good. There was a technical analysis team, and then they swapped roles. That's something I definitely would like to do again, just to kind of help solidify. But I want to give you guys the tools first, because I don't just want to say, all right, day one, go find this. Like, that's not healthy. Yeah, Snowflake, TNT, Chag, and Duco. That's awesome. That's power team right there. Makes sense. Okay. Yeah, I'm going to try to record, Charlie. I can't guarantee it every week, but I would like to. And the reason I say that is because some weeks I just might not be home, like for Trader's Paradise, for example. We may have to skip a week here and there, but the idea is that we're going to have... this will be a little bit less regimented than the coaching programs. Like, the coaching programs are on a very fixed schedule with kind of like repeating content. This is more organic, and my goal here is to make sure that we kind of go at their pace. because it's going to be their portfolios. I want to make sure they're able to make their own decisions. And I'm just kind of here to mentor publicly, if that makes sense. So it's less module oriented. So next week we'll cover the budgeting and credit and all that good stuff. We'll give kind of a financial literacy, crash course / masterclass, somewhere in between. And then we're going to talk about the contributions and how we split those up specifically in practice. And also we're going to set up the spreadsheet and kind of track all the different columns of, dividend income versus reinvested, capital losses versus capital gains, and then the different types, and then the individual positions as well. And on the spreadsheet, I don't care about your speculative stuff. No offense. It just doesn't matter to me, because again, my goal is to see where your floor is and watch that floor rise. I don't care so much about the ceiling. That'll take care of itself as the floor rises. So don't feel any pressure in here to be good at speculating. My only concern is that you don't take more out of the speculative allocation or out of the investment allocation to speculate with. And that's going to be a big challenge, I think, for most people. But we have ways. Cool. You block this time slot for the next decade of your life. Awesome. Well, I look forward to it, and you're on the team, so we're going to make it work. So also, just to be very clear here, there's a Rags to Riches channel. All of the legacy members, all the people that were currently in Rags to Riches, you guys will still have access to that channel. That doesn't change. That's always going to be there for you guys. The only thing that has changed is that I'll just be focusing on these 10 members over the next couple of months. And I would love it if you guys all help each other. You guys always do. So feel free to chat in that text channel that's also visible to everybody. And then everybody can, many hands lift all boats, I guess is an amalgamation of phrases there. But that's the idea. So you guys are not going anywhere. No offense to the new 10 people. They're not special, but they kind of are in that they're getting the attention right now. And that's just to get them up to speed and kind of lock in the process. And again, the goal is to demonstrate a consistent 3-month growth trajectory on their portfolios with very little effort and without a whole bunch of technical stuff. So we'll cover that. We'll get there. And then the data will show that this process works. And then I will just continue putting it in front of everybody to the best of my ability, and you guys will be the proof. And then people will choose to continue, hurting themselves, and some will see success, and that's awesome. But my goal is to harvest the many that don't, and to bring them into a safer approach. Just like Bull with the passive options, Lee with the higher time frame, and the slower, the rest retire stuff. It's got to be more than just 1 minute time frame, grab this, grab that, panic. That's not trading. That's certainly something, but there's so much more beyond just that. Okay, so we're going to build an engine that lets us mess up completely on that side and still grow a portfolio. And then we're not going to blame ourselves for being human and just not being able to control our impulses. We're going to hold ourselves accountable, but we're not going to beat ourselves up. And all the while, this floor will get higher and higher and higher. And that's about it. That's the goal. You'd like to observe as much. Kenny, you're here, man. You can. Everybody here can observe the Rags to Riches stuff as much as possible. There's no bar to that. This is the foundation. The foundation will always be free as far as I'm concerned. If you want to optimize it, then you got to do the speculative stuff. But this will always be here. This is just basic financial literacy, basic investing. Now we're going to tweak it. We're going to ramp it up a little bit because we're here. But everybody can always watch this stuff. I don't have any issue with that. I just don't know. I can't commit to focusing on other people's portfolios, for example, beyond the 10. So, no, I love having you here. The more the merrier. Bring everybody. Bring all your family, friends, classmates, coworkers, anybody. I'm also going to be posting these videos on a YouTube channel that is dedicated specifically, well, it's my YouTube channel, but that's going to go on a Facebook page as well. That's dedicated just for this. So with that said, I am going to cut that recording off right now. We're about 49, 50 minutes in, so I don't want to make these too long. But I wanted to give you guys plenty of time to ask questions and to make sure that you're familiar with the process. So again, really quick before I cut this off, we're going to focus on financial security, meaning budgeting, visibility, credit building, and maintenance. Then we're going to use what's left of that money flow. We're going to create a gap between inflow and outflow. We're going to then lean into consistent contributions that are reasonable and don't result in us eating ramen. Then that will grow the portfolio naturally. It's a savings account at that point. Then we're going to break those commitments up into an imbalanced ratio between long-term stable stuff and speculative stuff if we want to. And then each of those is going to have two outcomes. It's going to have some sort of profit or some sort of loss. Profits will always be reinvested. Losses will always be used to deduct against those income events from receiving cash. And then the specifics of how we do each of those, that's just going to require a little bit of a deeper dive, but that's the process. So this closed unit of compounding reinvestment is what we're after. Then we're going to use this as a means to an end, because over the course of time, we're going to build this up into ideally 7 or 8 figures, and then we can take that asset pool that we've built, this big portfolio, and then we take that over and get an S block, and then we offset taxes even more. And then it's just a game of how efficient can we be at not paying so much in taxes. So there is an end goal, but it's not just making money in terms of how big we can make a portfolio. Then towards the end of that, we're also going to be talking about purpose, direction, and things that nobody really gets to focus on because everybody spends most of their life in survival mode. I can't say everybody, most people. So your identity is very closely attached to survival and making money, not so much with living with money, because everyone's taught how to make money, but not how to live with it. And once your needs are met, you no longer have to work. You don't have to be miserable. And then what the hell do you do, right? A lot of people chase stimulation. A lot of people resort to self-destructive behavior because they can't shake they want to revert to what's familiar, so they sabotage. Other people commit to too many causes and spread themselves too thin, or any number of outcomes can happen. So we're going to talk about that too. We're not going to go as deep as we go in Lifetime, because Lifetime, we talk a lot more in depth about wealth management now. And we get a little bit more technical on a lot of stuff, but this is the foundation. So this will be more than enough to get you started and get the concepts in your brain. And then we'll go from there. All right. So let me end the recording. I appreciate everybody hanging out. Let me just get that paused.